Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Rob Chrisman. Topics on today's episode include commercial mortgage-backed security, lending, and I have some more thoughts on the shape of our yield curve. An interview between Rob Chrisman and myself on what the shift from summer to fall historically means for the mortgage industry, as well as how lenders are getting creative with their product offerings, and why we're seeing mortgage applications continue to slide. Thanks to today's podcast sponsor, Gallus Insights. Mortgage KPIs automated at your fingertips. Gallus allows you to turn data from your various databases and systems into automated business intelligence and actionable insights. Learn more at gallusinsights.co. 'Twas the 3rd of September, the day I'll always remember. Wherever he laid his hat was his home, and when he died, all he left us was alone. Okay, maybe it was alone. Alone? What? One is a space and... Residential lenders aren't alone out there. Get it? Our fates and fortunes often move in tandem with commercial lenders, so it's worth noting that the delinquency rate on commercial mortgage-backed securities, or CMBS, for offices, surged 62 basis points in August to a record 11.7%, a full percentage point above the post-2008 peak of 10.7%. Returning to the resi sector, there's noise out there about the government declaring an emergency about it. Just what that would mean remains unclear, but stay tuned and I'll probably have some more reporting for you on it later this week. And I'm proud to report, I think we got the exclusive embargo, PennyMac today announced that its correspondent group will launch a new suite of non-QM products on September 22nd, expanding access to flexible financing for borrowers who do not meet traditional agency criteria. Pretty big news there. And you'd think that during this holiday shortened week, the focus would be on the first wave of high-profile August data, with the most attention going to Friday's August payrolls report, where the headline's expected to register around plus 75,000. However, an appellate court ruled against most of President Trump's tariffs yesterday, deeming them invalid from September 16th. It's a case that will likely be escalated to the Supreme Court, so the final outcome remains unclear. During the first half of this year, economic growth slowed substantially as tariffs have raised taxes and generated a great deal of uncertainty. Yes, Trump has been quoted as saying that the goal of restoring American manufacturing justifies some short-term pain, but he'd prefer an inflation-wary Fed bail him out by slashing borrowing costs. And yes, the tight monetary environment, partially due to Fed policy, is weighing on economic activity. July saw residential construction inch upward, but overall spending fell due to weakness in the non-residential sector. Meanwhile, the ISM Manufacturing Index remained in contractionary territory for a 6th consecutive month, despite minor gains in new orders and a drop in input costs. Economic data released yesterday showed another contractionary reading of the ISM Manufacturing Index for August, though the reading was a touch better than expected. Fans of adjustable rate mortgages know that in August, the yield curve steepened, driven primarily by a sharp 34 basis point drop in the 2-year yield, while longer maturities, particularly the 20 and 30-year bonds, barely moved, reflecting ongoing inflation concerns and investor reluctance to lower long-end rates. Despite expectations for an upcoming Fed rate cut, persistently elevated core inflation, currently at 2.9% for PCE and 3.1% for CPI, continues to challenge the Fed's 2% target and dampers enthusiasm for longer duration assets. Yields remain stuck in familiar ranges, with 2s near 3.65%, 10s just above 4.25%, and 30s approaching 5%, a level made more resilient by sticky inflation dynamics and uncertainty around new tariffs. Global influences, particularly surging UK gilt yields tied to budget worries, have helped reinforce a preference among investors for shorter-term securities, making it harder to justify extending duration. For today's interview, I wanted to welcome back to the show Rob Chrisman, the real Rob Chrisman, for a discussion on what the shift from summer to fall historically means for the mortgage industry, as well as how lenders are getting creative with product offerings. We've seen a proliferation in the non-QM space. We've seen a proliferation in the HELOC space. We've seen, some would argue, Fannie and Freddie become less competitive, whether that's by design or organically or an accident, who knows? How creative can you start seeing the credit box get? I know I mention the people at Figure all the time because I used to work with them, but thoughts of like an open end first. Obviously, people threw out the 40-year mortgage for decades, but I don't think that's going to happen. But like an open end first, or is the non QM space fully catering to the needs of the modern borrower? Do you think we'll continue to see capital get creatively applied? Investors on the back end saying, "I'm comfortable with continuing to push the envelope when it comes to innovative products."
I think that investors in mortgages and mortgage-backed securities continue to look for yield. So if there's a product where the ability to repay requirements are met at a good yield, you'll see demand for that. In terms of going back to stated this and stated income, stated asset, that kind of thing, I don't think anybody should get their hopes up too high on that. And frankly, inventory levels have crept up. So when people talk about a housing crisis or the government talks about declaring a housing emergency, as we've talked about on the show, it's not only mortgage interest rates problems. We're dealing with insurance costs, we're dealing with condo costs, we're dealing with special assessments, we're dealing with property tax increases. And just the cost of ownership in general has gone up. What you pay for a plumber is far higher than what you paid for a plumber a few years ago. And so overall, the costs have gone up. Mortgages are part of that, and mortgage interest rates are a little bit sticky on the upside. They're still relatively high relative to Treasury rates. So we may see that spread come down a little bit, but the affordability continues to be an issue, but it's still, once again, only part of interest rates problem. So if you look at the cost of originating a loan, it's still around $12,000, and that's a problem for lenders and it's a problem for borrowers because lenders have to cover that cost somehow and borrowers have to pay it. So there needs to be an adjustment, and I think that in terms of products that are being offered, non-QM, a lot of originators have drifted that way or consciously moved that way toward originating that product, which is good. They're helping their borrowers. That'll continue, but we still hopefully keep in mind that the borrowers need the ability to repay. We don't want to give somebody a loan that they can't repay. So the requirements are there for a reason. I don't see those going away, but yeah, there could be some creativity. I don't know how much benefit a 40-year mortgage, for example.
No, no, I don't think that adds benefit. But I think maybe like an open end first adds benefit and could deliver good yield for investors.
Yeah,
Yeah.
I could see that happening.
Yeah. So let's close with something to get you riled up, and that is rates. You mentioned it, insurance costs and property taxes. Those are the things that scuttle a deal rather than rate. But the general public's so focused on rate. And I actually had a different show that I did recently, a video show, Mortgages with Millennials, one of our Chrisman shows, which hopefully people go check them out if they haven't already. But someone was talking about rate, and I said, look, rate's important to the uneducated borrower, but the educated borrower or the good loan originator advising their client will tell you payment is what's important. And I say all that as kind of a preamble to you and I. If I had a dollar for every time I said the Fed doesn't set mortgage rates this year, I might be able to afford hazard insurance on my house. The Fed doesn't set mortgage rates. The Fed sets the front end of the yield curve. You and I had a little write up yesterday about how spreads from treasuries even to mortgages are historically wide. So just because the Fed cuts rates, mortgage rates, sorry, just because the Fed cuts the overnight Fed funds rate doesn't mean mortgage rates are going to come down. In fact, since the Fed started easing basically exactly a year ago, mortgage rates have gone up by about 50 basis points on average. And so I'm wondering how the industry gets the general public away from rate. Oh, the Fed, if the Fed cuts rates, mortgages are going to become more affordable. It's going to be boom times, and how we move toward a more common sense view of what home affordability means, or actually getting it to have legislation passed in Washington that let's commensurate with it being the bipartisan issue that Americans are struggling with day to day here.
It starts with the loan officer's contact with the borrower or potential borrower. And when you listen to an experienced loan officer who's doing well, they rarely talk about rate in the first discussion. If a borrower calls up or potential borrower calls up and wants to know, hey, what are your rates? They will say, well, those vary by credit score and maturity. And let's talk about kind of programs we offer. And let's first talk about you, Mr. or Mrs. Borrower. How did you get my number? How did you get my name? Tell me what you're trying to do here. Tell me your job situation. Tell me this, tell me that. And so the conversation goes down the path of what kind of borrower am I dealing with here? And a good loan officer will know pretty quickly whether they're dealing with a conventional conforming kind of borrower or FHA or VA or a non-QM or some kind of portfolio product. And then you get into a discussion of, all right, well, let's take a look at your credit and let's figure out an ideal program. And by the way, almost we offer, we're going to offer competitive rates, but the rate isn't where I'm, can give you the best product, give you the best service, give you the best value for your money. I'm going to give you a great rate, but I'm going to do it in a program that fits you and what you're trying to accomplish. And so it starts with the loan officer.
We could talk about what it means coming out of the dog days of summer now that Labor Day is behind us, what that means traditionally for the mortgage industry. We could talk about upcoming speaking engagements for you, me, both of us. We could talk about what you're seeing in the general lending environment. What would you like to focus on?
From what I'm seeing, borrowers need products and lenders are trying to offer those products. And so Labor Day is behind us. We can stop wearing white shoes, which is the traditional thing that happens at Labor Day. Most people who are going back to school are back at school at this point. Lenders and originators are faced with, once again, trying to help their borrowers. And there's hope out there that rates will go down. The expectations are that the Federal Reserve will cut short-term overnight rates, at which point the market may be saying, well, gosh, long-term rates haven't moved much. Now, granted, long-term rates have come down a little bit. That's a good thing. But as we've said many times on the show, hope is not a strategy, and hoping that long-term rates will come down is nice, but it's not what I'm seeing good loan officers do. They continue to chug along regardless of the rate environment.
I don't want to bore people, though. Let's rank fall on Rob Chrisman's favorite list of seasons. I was in Cape Cod this weekend for Labor Day. I'm now in the Lake Tahoe area. Summer has broken in the mountains. I saw it flying in. You see these big clouds building, and a lightning storm opened, and summer breaks. And I hate when summer breaks. I like summer, especially in the mountains. I didn't get enough mountain time this summer. I know Halloween was my grandmother, your mother's favorite holiday, but where does fall in general rank in your seasonal rankings? And you can add, if you want to keep it germane to the podcast, where it ranks in your personal seasonal rankings, and then where you feel like it ranks for good times in the mortgage industry. And that's kind of an open-ended question. MBA annual, but times are trailing with people going back to school. However you want to answer it.
I like the autumn. I like thinking that fires in the fireplace are ahead, and Halloween's ahead, and leaves turning color are ahead. And typically, autumn is a time of good weather around the nation, so flight delays tend to be lessened, I think. I don't have scientific proof for that, but nobody likes flight delays, and it seems like everybody has their flight delay stories these days. In terms of lending, I would say that traditionally, the buying season has ended. People are back in school. Kids are back in school. Any families who have thought about moving have. And so the refis, as we've seen from the MBA numbers, have picked up. So with interest rate cuts ahead, the autumn should be decent. Now, from a conference perspective, July and to some extent August tend to be pretty slow, although Michigan mortgage lenders is in August and the California MBA is in August, and it'll be next August as well, the Western Secondary. The conference season picks back up again. And so I know that you and I are doing some traveling coming up. We've got some private events. We've got Acuma. We've got some other state level events. And so September conferences pick back up. And I think attendance should be good. October, we've got the national, and then November, some other state level events. And then December dies down again. So September, October, to some extent November, conferences pick back up. And I think people genuinely like seeing one another and hearing what's going on with everybody, touching base and so on. From a volume perspective and from a profitability perspective, autumn tends to be decent. So, yeah, I think the industry tends to look forward to autumn.
The nearest thing on our calendar is the Pacific Northwest Mortgage Lenders Conference in Boise, Idaho next week, where we'll be speaking. If I have any elderly fans out there collecting Medicaid or Social Security, should be letting the green shoots industry pop up, but they are not. They're sticking around. I'll be speaking at the National Reverse Mortgage Lenders Conference at the start of October in Minneapolis. So take out your dentures or put in your dentures and come say hi to me. Anything else to add for today?
I know that a lot of people love football. It's nice to see football. I sorry about your Longhorn loss.
I'm a California Golden Bears fan, and they beat Oregon State, so I'm happy. Cal's 1-0.
Congratulations.
Well, that's your alma mater too. So,
yes, sir.
Today's economic calendar kicked off with mortgage applications decreasing 1.2% from 1 week earlier, according to data from the Mortgage Bankers Association's weekly mortgage application survey. Later today brings Redbook same-store sales for the week ending August 30th, July factory orders, July JOLTS job openings, Treasury activity that will be headlined by a buyback in 10 to 20-year coupons for up to $2 billion, and remarks from St. Louis Fed President Muslim and Minneapolis Fed President Kashkari. We begin the day with agency CMBS prices unchanged from Tuesday's close, the 2-year yielding 3.65 and the 10-year yielding 4.27 after closing yesterday at 4.28%. Let's wrap up with a joke and some housekeeping. If you're being chased by a pack of taxidermists, don't play dead. Thanks again to Gallus Insights. Mortgage KPIs automated at your fingertips. Gallus allows you to turn data from your various databases and systems into automated business intelligence and actionable insights. Learn more at gallusinsights.co.